one of the questions I get asked fairly frequently is, hey, Azul, if I've got extra money, should I think about paying down my mortgage or should I think about investing that money? It's a really important question. And over the arc of 10 years, it can have a substantial impact on your financial well-being. So I want to chat about that today. And first, I just want to acknowledge that there is the academic side to this question. What do the numbers say? And then there's the emotional side. What's the right answer for you? So let's start with the numbers, and then we'll get to what I think is even more important, the emotional side of things. So as I record this, the 30-year mortgage is just a tad above 7%, and the 15-year mortgage is just a tad above 6.5%. And importantly, if you're thinking about paying down your mortgage, it's fair to think about that as similar to a guaranteed return. And there are very few guaranteed returns in the world, right? I mean, we have our FDIC insured bank accounts here in the United States. You might invest in short-term United States treasuries or bonds because the government can print money. Yeah, we don't have to worry about getting our money back. Doesn't mean that it's completely without risk. Those are guaranteed returns. But outside of that, there are very few guaranteed returns. And if you're paying what mortgage rates are currently, to get a guaranteed return of 6.5%, if you're looking at a 15-year mortgage, or a little over 7%, that's a substantial return for something that's guaranteed. Now, everybody's situation is going to be different. We have to look at what the after-tax impact of our mortgage is, right? For many of us, our mortgage rate is deductible, what we pay in interest, but we also have to ask ourselves, are we using the standard deduction? Because if we're already using the standard deduction, which is pretty high, in 2024, the standard deduction that you get to deduct off of your taxes is $29,200 for somebody married filing jointly, and it's half of that, $14,600 for somebody that's a single person. So if you're using the standard deduction, you're going to get that whether you pay off your mortgage or not. So deducting what the tax benefit to you is less of an issue for you. So the academic answer is if you have a mortgage in the 6.5% to 7% range, that's a really nice guaranteed return. So it's hard to make the argument that you're going to do better in the stock market. You might, but you're also going to take risk, right? The stock market can be down 10, 20, 30% in a year. And so, yes, if you take that money, let's just for the sake of argument, say that you take $10,000 and instead of paying off your mortgage early and putting that towards your mortgage payment, instead of doing that, if you invest in the market, you could lose of that $10,000, $1,000, $3,000, $4,000 in 12 months. Where when you put it towards your mortgage, you know that that is reducing a liability that you have. So that's the argument for paying it off. Now, I know many people in my audience have a mortgage that is at a much lower rate, and so the math is more difficult to argue for paying off that mortgage early. If you have a mortgage at 2.5%, 3%, 3.5%, that's inexpensive money. And not only is it inexpensive money, but it leads me to my second point, which is once you pay down that debt on your mortgage, once you apply that to your mortgage, that is money that you don't have access to anymore. So in my industry, we call that optionality or liquidity. You've lost that liquidity. It's now tied into your home equity, which you either need to take a line of credit, a home equity line of credit, or you need to sell your home to unlock it. So that's the math, but stick with me because there's a middle ground here that I think can work for a lot of people. But first, I want to talk about the emotional side of this, because just because the math says if you're in a 6.5% or 7% mortgage, it probably does make sense to academically to start paying that off. I should mention none of this is financial advice. I don't know your situation. And as I mentioned earlier, your tax rate and whether you're taking a standard deduction all comes into whether it makes sense to do this. So I just want to put these things on your radar screen for you to think about. But on the emotional side of this, and oftentimes with my clients, I find this is what drives them more than anything else is, do they find it painful? Do they not like having that obligation over them, the weight of having a mortgage that maybe they have another 10 years to pay off, and maybe they're hoping to retire in 5 years. And when they retire, they'd really like to be debt-free, which I think is a wonderful goal to have. The question is, from an emotional standpoint, who are you? Does it bother you to have a mortgage? Does it give you sleep at night factor? Also, how secure is your job, right? If you work for a company that's regularly doing layoffs and you've dodged the bullet until now, but you think, bullets don't have names on them. They get launched, as Jocko Wilkins would say. They get fired with "to whom it may concern." So just because you've dodged the layoff bullet in the past doesn't mean you're going to dodge it again in the future. So if you're worried about that, boy, the peace of night factor that comes into being, knowing that you've paid off your mortgage, that can mean a lot to people. And what I have found is as people get closer to retirement, that peace of mind, that freedom of knowing that they don't have a mortgage can be very, very helpful, can be very liberating for them. So there is no right answer, but oftentimes it's both. And so I want to share with you two strategies, regardless of the academic answer or the emotional answer for you. But oftentimes both is a good answer. And I've got two pieces that kind of navigate both. One is, instead of, in my example, you had an extra $10,000. Should you use that to pay down your mortgage or should you invest? One answer is to half of it goes to pay down the mortgage, the other half goes to invest, right? Oftentimes both is the best decision. But in this case, I think there's a third option. And the third option is available now because money markets and the interest rate we can get in our bank accounts right now is higher than it's been in a decade. So we're finally getting interest rates up, and many of us can find 5% in a local bank account. So that $10,000, you could split it. You could pay down half of your mortgage and you could invest the other half. Another thing you could do is you could put that $10,000 in a higher yielding FDIC insured bank account, maybe a CD that's paying 4 or 5%, maybe a little bit more than that. And that makes it where it's not a today decision. You can sit with it. You can think about it. Or you could incorporate that into all three and do the both, but both being split it between three. You spend a third of that to pay down your mortgage, you invest a third of it, and you put a third of it in the bank. And every year you revisit that money that's in the bank and even the money that you invested and say, do you want to pull that out and pay down the mortgage, either from the bank or from the investment? So again, oftentimes both or all three can be a great option. But what I do want to leave you with is you want to be thoughtful and deliberate. You want to have a strategy, just like it comes to thinking about when you're going to retire. Too many of us sail through the youth of our senior years, not being thoughtful and deliberate about whether we want to retire now or postpone. And again, there's lots of different ways to look at this, which is why I made this video here, which talks about 5 reasons to retire as soon as you can. Thanks for watching this video, and I'll see you in the next one. Bye-bye.